We're going to do a brief video of technical analysis, and we're going to make it just as absolutely simple as we can. So the first thing we want to do is understand that technical analysis can be broken down into two areas. The first area is subjective technical analysis, and the second area is objective technical analysis. Anything having to do with pattern recognition that's not done by a computer, and which in other words quant trading or algorithmically generated trading, is subjective. If you're going to use flags and support and resistance and all those Gann theory, all of those other things you've heard about, those are subjective trading systems. And for the vast majority of people, they're worth nothing. They don't give you exact entry prices. You don't have any statistical data to look at in the past and see how they would have worked in the past, and you can't backtest them. Keep this in mind whenever you're thinking about a trading system to use in the future. Can you backtest what you're thinking of doing to see if it worked in the past? Now, absolutely, past performance is not an indicator of future performance, but it's better than nothing. So we're going to break down for you two simple objective systems for technical analysis. We're going to skip all the rest of it that's subjective, because you cannot backtest a subjective system. That was told to me by a money manager years ago, and it was one of the best pieces of advice I ever got. So we're going to show you the first one, and if you stick with me to the very end, we'll show you the second one, which is going to be very quick. The first one is not a moving average crossover system. It uses moving averages, and so we're going to go from the very beginning and show you how to pull them up. What I'm doing here is I'm on a chart that I got from TradingView, and it's free. You can go to tradingview.com, you can subscribe, you can get them free. I get this little widget for free. You can do the same thing. It's not great, it's not, it's great, but it's not always live. In other words, it's not always up to the second correct, but it's free and it's great for doing a lot of technical analysis. So let's first put on here 3 moving averages. We just click it 3 times. And then what we want to do is go in here. We're on a daily chart of Apple, but I'm going to show you other charts. The chart that we're on, the instrument that we're using is important, but not necessarily right this moment. So the first thing we're going to do in here is go in here and set up these moving averages the way you should set them up consistently, but you should set them up in colors and in periods, meaning the days or the length of time, the way you feel they should be set up. But in general, I'm going to give you those things, and it will work if you use what I give you for our purposes. Everything that I'm showing you is for entertainment purposes only, but it will work for entertainment purposes. So let's take a look real quick and see how this goes. So we put a 5-day moving average there, and we're using the close. So we're setting our moving average up using the close. You could use the high, you could use the low. I've tested all of that, but we're going to use the close. There are reasons to use a moving average of the high or the low or the close, but we're just going to use the close here today. And what we're doing is setting up 3 moving averages again, and I'm going to recap here real quick in a minute, but we're setting up 3 moving averages. We have a blue 200-day moving average, a red 20-day moving average, and a green 5-day moving average. Now, all these big bars down here, these are volume. We're going to get rid of those. So now we have a clean chart of Apple. It's a daily chart, and we now have context. Moving averages do the same thing for you as if you put a grid system of longitude and latitude over the earth. It doesn't predict anything. It just gives you something to place yourself and place where you are relative to where you could be. That's what a moving average does. It's not necessarily a predictive system, it's a tool, and that's the best way to look at it. So when you're looking at a tool, would you use a hammer that broke your thumb every 10th time you've used it? I wouldn't. I'd throw it away. So I want reliable tools, and that's why I don't use subjective tools. I use objective tools that I can backtest with a computer, and they'll tell me statistically over 2,000 trading periods, this is what the numbers look like. Is it going to guarantee work in the future? No, but it's better than a hammer that doesn't work every 10th time and smashes my thumb. So let's take a look real quick and see what we got going on. Now here's the most basic way you would use moving averages. You'd set them up. Now, why did I select a 200-day moving average? Because it's convention. It's convention. That's what most people in the stock market do. They set up a 200-day moving average. So it's not a miracle that the stock bounces off this. It's not curious that the stock bounces off this here or almost bounces. It's not curious that it bounces here. These are just people watching the 200-day moving average. It's not a prediction. It's thousands, and in some cases hundreds of thousands of people watching Apple and saying, oh, it's a low risk trade to buy here. It's up against the 200-day. These people bought early. They were like, I really want to buy. I'm not going to wait. And a lot of people felt like that. So it didn't get to the 200. These people were like, oh, yeah, I'm not sure. So it went through on the 200. Then they bought. These people were like, no, I'm definitely not buying on the 200-day moving average. So we went into a bear market. But then when the price got here, enough people said, oh, wait a minute. Yeah, it's now worth buying. And I'll show you another chart in a minute that explains a little bit further what happened here. But you can clearly see that if you put moving averages on here, all of a sudden, technical analysis begins to make sense. And you'll notice I haven't had you memorize anything about flags or support or resistance or nonsense that can't be backtested. We're looking at 3 moving averages, and most importantly, we're looking at price action. So let's take a look here real quick and show you a very simple system that you can start using tomorrow. Ignore first the 200-day moving average, although it's important. When we're above the 200-day moving average, that's a bull market. When we're below the 200-day moving average, that's a bear market. It's pretty much all you need to know about bull and bear markets. Now, let's take a look, and we're going to build a trading system real quick here using simple technical analysis. Not something that somebody's a flag or support and resistance or nonsense, but something you can do yourself tomorrow when the market opens. We're first going to look at the red 20-day, the green 5-day, and price. Now, we're not going to do this when it's sloping down. We're going to do this when the 20-day is flat or sloping up, because we're going to buy. When the price is moving down, when the price is below the red 20-day moving average and the 20-day moving average is sloping down, that usually means lower prices. When the 20-day moving average is moving up and prices above the red moving average, that usually means higher prices. It's not always true, but it's usually true. So if we looked right here at the beginning of the crossover, it was below. Now it's above the red line, the 20-day moving average. And we simply said, okay, well, what about the 5-day moving? Oh, look, the 5-day moving average is above it too. And so is price. So price is above the 5-day moving average. And the 5-day moving average is above the 20. So everything is above. Green is above red, price is above green. So now what we do is we take a look and we say, what is the close this day? I'm talking about this bar right here. What is the close? And the close we look up here at the top is $127.35, $127.35. So that is now an objective buy price for tomorrow. So in this example, we're looking for June 11th, or we're looking at June 11, 2021. We now have an objective buy price. How did we come up with that? How can you come up with that yourself? We took a flat to slightly rising 20-day moving average. We took a 5-day moving average and we said it's above it, and we took the close today. We're doing this after the market closes on the 11th of June, and we now say price is above the 5-day. So price is above the 5-day, the 5-day is above the 20-day. Boom, that's a trading signal, that's entry, and we have the price to entry at 127.35. Now that's critical. I've backtested these systems. It's absolutely critical that you have a specific entry price. So 127.35. So now we go to tomorrow. It's tomorrow morning. And we're looking for a buy price of 127.35 to happen. Because if it doesn't happen, we're not going to get in the market at all. That's very important to the success of this system. So technical analysis has to generate a specific entry price. If it doesn't, down to the penny, give you a specific entry price, you can't backtest it. So the first thing we see here is our closing price is a specific entry price, 127.35. So now we ask ourselves the question, can we get in? Well, sure we can. Look, it traded at 127.07. That's below 127.35. So we get in, we buy. So now we're in the market. We're in Apple on a daily chart. So what do? Well, we don't do anything. We do nothing until the 5-day moving averages crosses down below the 20-day moving average. So in this particular case, and I chose this random, but admittedly it's a good case, we said 127.35 is what we chose, right, for our entry price, 127.35 on the 11th of June. We could ride this all the way up here to worst case, let's just say down here, right? And if you wanted to, we could go all the way up here and take the worst case where it first closed on August 2nd. We close it out. And we'll close worst case the low of the day, 145.25. 145.25. We got in at 127. So what did we make? A little less, 18 bucks a share, something like that. So that's a very, very simple, very, very important classic example of technical analysis without all the mumbo jumbo. It gave you an exact actionable entry price that you could back test. You can build this formula on an Excel spreadsheet. You can program this algorithm on an Excel spreadsheet. It's super easy, and you can test for yourself going back as many years as you want to test. And then you can send me an email or send me a message in the comment section and say, hey, Tony, that works, or it didn't. But it's going to work on a lot of markets, and I'm going to show you some other markets. So that's how you would build a simple trading system with technical analysis, with no mumbo jumbo, and without taking 15 years to learn flags and support and resistance and acting like you know what you're doing. So we could get out, depending on our risk tolerance, any time through here. There's no reason for us to stay in the trade. Keep in mind there's two separate things: getting in the trade and getting out of the trade. Those are two vastly different things. Getting out of the trade is a completely different skill set, in my opinion, than getting in the trade. And both are ridiculously important. I've built a lot of trading systems where you're leaving 2/3 of the move on the table, but they're still very profitable. So it just depends on how much risk you want to take in terms of sleeping at night, day after day after day after day, because you don't want to give back profits. Look how much profit was given back here. This was 150. This was 140, let's call it 142. It's $8. A lot of people would just go crazy if they left $8 on the table. They'd want to get out of here. So that's a very, very touchy subject of when you get out. But objectively, we're saying we're definitely going to get out right here when the price closes below 20-day. And that, as best I can tell, is the first day. You'll notice that red bar right there on the 2nd of August 2021. You can look all this up for yourself. This is a chart of Apple daily chart. You get out. And you take out more than 15, 18 bucks out of this stock with no headache, no sweat. You just get in there and do it. Now, of course, it's all for entertainment purposes only. You have to test it yourself. You can't rely on anything I'm saying. Let's back up a little bit and say you're a very aggressive trader and you want to short. Because we just bought here. But let's say, hey, Tony, I'd like to do some shorting. Let's go right here. We take a 20-day and we wait for it to fall. Because remember, we're going to buy, so we're waiting for it to rise or flat. 20-day, we wait for it to fall. So let's legitimately say it fell on this date. So on this date, February 19th, we had it below the 5-day, below the 20. The 20's coming down. So we say, hey, boy, we're going to short today. So what was our close? 129.87. So can we get in? 129.87, can we get in? Nope, we couldn't get in. The high of today is 129.72, so we couldn't get in. That's very important to understand. That is the signal not to go short. If you can't get in, don't fudge it and do it in and go short anyways at a lower price. If you can't get in at the price that you calculated, 129.87, that means don't get in that day. So again, I want to emphasize, you need a way in technical analysis to get yourself an exact entry price and then the next day follow it. Now, let's just say that you could do better than your price. So let's say that you set 129.87 and the market on the next day traded to 131. Then of course you still at 131. So you can always take a better price assuming it's traded through your strike price. So your strike price in this case would be 129.87, and let's say, well, I think it's going to go a little higher and I'm going to short it, so I'll short it at 130. Great. But under almost any system I've ever tested, you have to wait until the market trades through your price, and then you can get a better price. So we couldn't go short today under our rules because it didn't fill our trade. Does that make sense? It does not fill our trade, so we can't go short. Even though it was a good trade, we don't take it. We wait until it fulfills our needs. So if we go and we take a look at this right here, we can clearly see that we're flat on the 20, and this is a little risky. I don't know if I'd take it, but let's just look at it. Flat on the 20, the 5's below the 20, and the close is below the 5 and the 20. So the close here was 127.85. We're looking to go short. So we're looking the next day to see if we can enter at 127.85, and we can't, it says. We cannot. So it's another one that protects you, because look what happened. It went and it rallied up, but that's no big deal. Just stay out of it. The point is, I'm showing you that not always will you be able to get in, and when you can't get in, don't fudge it. Just stay out and wait for your setup. I can easily pick another one here and find you one where you can get in. For instance, right here. This, I don't know. Let's take a look here. That's not a good one. Let's take a look at this one. You can't get in there. Let's see if you could have got in here. So this one is 148.79. The 20-day is flat. You're looking to go short at 148.79 the next day. And we have the green is below the red. The price is below the green at 148.79. And we look the next day, 148. Yep, we could have got in just barely, so we go short at 148.79. And boom, we would have made $7 almost the very next day. And we could have taken our money and made $7. We could have, right here, we could have gotten out, although it's not a great way to do it, but we could have done that. I would have taken that money and taken $7 instantly. But keep in mind, $7 on a stock trade is not bad money. But again, getting out is more, it's not necessarily subjective, it's just there's more to it. It depends on your risk tolerance. But that's essentially how you use the same system I taught you to go long. You can use it to go short. So technical analysis, you can spend years trying to learn all of the details in technical analysis books, but at the end of the day, what you're doing is just wasting your time. I don't mean to be negative about it, but the reality of the situation is you're not going to ever get anything you learn in technical analysis to work to where you can sleep at night with it unless it's objective. If it's subjective and you have to interpret it, then I wouldn't waste any time. My personal opinion, again for entertainment purposes only, but that's how I would look at it. Now, I'm going to show you, this is a daily chart. I'm going to show you the same thing with moving averages on a weekly chart, show you how you can make some serious money doing virtually nothing. Now, keep in mind, I'm pulling examples. Anybody can pull examples and show you how their ideas work. You have to test this for yourself. But using the same system, we have a very rapidly rising, this is now weekly, so this is a 20-week moving average, a 5-week moving average. We didn't really get a close below it, but let's say price dipped below it, because it did, and we want to enter this. We're bullish. So the 20-day is moving up aggressively and has been moving up to a 20 bar, I should say. It's 20 weeks. So we look here. We take the week of October 18th, and we see that it's closed at 148.69. We're above the green. We're above the red. Everything's sloping up. So we want to buy the next week at 148.69. So let's see if we can, and we could. So we're in the market at 148.69. All we got to do is hold that thing as long as our stomach can handle it. And if you'll notice, it never even closed below the 20 until all the way up here. So we said 148.69. Let's say worst case, we just got out early. We couldn't take it. 148.69, so we got out at, let's say we got out at 170. That's $22 in a few weeks, less than a month. So same trading system. You can clearly see here the short system. We went flat. Let's take this one right here because it was already clearly coming down in a negative way. We're sloping down on the red. We're going short now. So we have a price closing below the 5-week, the 5 weeks below the 20-week. We get our exact entry price of 157.65 on the 25th of April, the week of the 25th of April, 157.65. And let's see if we can get in the next day. 157, what do we say? 157.65. And of course we could have got in. So we're in the market short now at 157.65, and boom, we just get out the next week. We just I mean, how greedy can we get? 157, and all the way we get out, let's call it 140. So we've made over $15 in maybe 2 weeks, because each one of these bars is a week. So week and a week. So maybe we got a Monday and we got out Friday the last week. $15. We could have hold on and got some more money. But the point of it is, it works on a weekly chart as well, and it doesn't require you to sit there every day and look at it. You just can check it at night before you go to bed and see what's going on and get out. When this price closes above that, didn't really close above it until right here. So it closed above it right here on the week of the 21st, and that would have been your signal to get out. Again, keep in mind, you could have got out here, you could have got out here, you could have got out here, and it's made tons of money. So this technical analysis system that is so simple, so objective, can be back tested on an Excel spreadsheet. I've done it. I'm not going to put any guarantees on anything. You have to do it for yourself. But this system is in my opinion, what technical analysis is all about, because it's objective, it's straightforward, and it gives you an exact entry price. That's the key. Objective, so you can back test it, and an exact entry price. That's the key. So this is technical analysis in the most simplest way that I can explain it, because technical analysis is very simple. The rest of the nonsense, in my opinion, I don't mean to degrade anybody, but to try to teach people how to do something subjectively and expect them to be able to pick it up in a reasonable period of time is ridiculous. Now let's go and talk about some very important things when you're using moving averages. You'll notice this trade action on a daily chart is extremely choppy. I'm going to show you something that is just amazing, how you can use this system. First we'll go to futures. We're going to use the same system. We're not learning anything different. We're just applying it to different time frames, and we're applying it to different instruments. And this is very, very important. Moving averages stay the same, 5, 20, 200, but we're applying them to minute, hourly, daily, weekly charts. Now we're on the S&P 500 E-mini futures, and this is one of the most liquid futures contracts in the world. The first thing you want to understand is all securities trade a little bit differently. Stocks trade differently than commodities. Crude oil trades a little differently than indexes. So if you look at it as a group, currencies are going to trade differently than stocks, and stocks and currencies are going to trade differently than indexes. But in general, the moving averages work on all of them. So let's take a look real quick at a 1 minute chart. Now we're going to 1 minute. Let me pull it up here. You know what? It's not going to let me do it on this one. But I will show you on a forex chart. This particular charting program is not going to let me pull up in it. But let me show you on USD JPY. This is a forex chart of the dollar versus Japanese yen. Now the first thing you'll notice when you switch to currencies, the trends are beautiful. That's specifically a characteristic of currencies. Currencies are heavily affected by interest rates. Interest rates are moved by governments in very slow fashion with a lot of warning signs. You'll notice the Fed this week just tightened again, raised interest rates. So currencies are going to trade very differently than stocks and indexes. Notice how beautifully they trend. Don't always do that, but they usually do that. So let's go and take a look at a 1 minute chart. See if I can get it to work. This is a 1 minute chart of this is not working real well. Let's just do a daily chart so that it'll work. This is a daily chart. We'll use our same system, and you can easily see how it works across stocks, futures, and currencies. Same thing here, Japanese yen. You can see price was closed on this day, March 11th. I just picked it out of random because the 20-day is flat here. So I picked this price. It's made a good move that day. The big number is 117.27. It's above the green. It's above the red. These are daily, so it's above the 5-day moving average, above the 20-day moving average. Our entry price is 117.27. Let's see if we can use it. We could not get in there. So let's pick another date. Same thing. Let's see if we can get in here. 118.29. And we can. So we get in here. It meets all of our criteria. The 20-day red is slightly moving up. The green is moving up. The price is above the green. The close is on that day was 18.29, and where are we? $18.18. So we're going to use this one. 18. Trying to find one that we can actually get in on. 18.18 was the close, and we can get in today at 18.18. So we do that. We get in there and we stay in there until price closes below the 5-day moving average. So we're in at 18 is the big number, 18.18, and we go all the way over here, and this is 123.20. So you could have made a lot of pips on this, way over way over 100 pips on this. Very simple daily, and getting out very, you could have got out worst case made 100 pips. So again, you could do the same thing short right here. The same setup, you could run it, just put it right here. You could go short, and let's choose everything's below. Red is above green, price is below green. So everything looks good. 128.20. And we could get in there, so we're in the market at 128.20, and if we roll down here just before it begins to close above, we could cover that. We said 128.20. We could cover that at again, maybe let's call it 125 to 150 pips. So very, very interesting way of using technical analysis and simple moving averages on the stocks and the yen. current, it works for all currencies pretty much that are major. There's 7 major pairs. And again, when I say it works, you have to test it yourself to see that it works. Let's go and check the stock indexes I wanted to show you. Let's pull up the S&P 500. Actually, I'm going to use a proxy, the S&P 500 E-minis. We're going to use this instead of using the minute chart on this. We'll use dailies. You can see there's all kinds of things going on in this chart, but who cares? We're just going to get short. Why? Because the 20-day is moving down. So we see the 20-day moving down. We see the 5s moving down. We see prices close below it. We're going to check it right here and check what we want to do. We're looking at 42.67 and a quarter. Can we use it the next day? 42.67 and a quarter. Yeah, so we're short at 42.67 and a quarter, and we're going to stay in there until the price closes back up. Now, I would never allow myself to get in this position, hopefully, but what did we say? 42.67 and a quarter, and I would have taken profits right here. 42.67, so you're down 150 points on the S&P 500. That's over $7,000 per contract. If you'd held it and let it rally back up on you, you would have lost all of those gains, but I don't know why anybody would do that. Once this thing sells down like this, you can get out here if you want to. You can get out here. Again, exiting is very subjective. Let's take our absolute strict rule of getting out when we're just not using any discretion. And let's find out where we are again. I've lost my place, but we can do it any one of these places where we meet the criteria. We don't care. We're just starting to roll. That's what we're looking for. It just starts to roll. We can go short here at this 42.67. That's where we were. So this 42.67, this horizontal line I'm putting in here, this 42.67, you can see how many opportunities you had to short there before this thing rallied back up and spanked you. Even if you held on to it here and rallied it back up, it wouldn't have put you down too much, a little bit. But I wouldn't do it that way. I would trade and bird feed it, which is take your profits as soon as you can get them and then put it back on again. It's more dangerous to put on this short position down here. It's definitely more dangerous. You want to put it on at the beginning. How do we know it's the beginning? Because the 20-day is starting to roll. And you can backtest all of this. You can backtest the with an Excel spreadsheet the first crossover system, and you're going to get you'll have when you do it for yourself and check it out, you'll see how these systems work, and that's why you should do it for yourself. Let's pick up another one right here. S&P 500 crossover system, simple. Price is above the 5 is above the 20, and we are in a specific buy price 39.3750. 39.3750. We could get in, so we're in at 39.3750. We use our rule. We go up here. 39.3750. The next day the high was 4,016. Let's get out of 4,000. You still made 50 points that day just using that simple maneuver. 39.3750. Get out right here before it crosses below. Just get out. You'd have made 50 points. That's 2,500 per contract on this S&P 500. 2,500 per contract. So again, you don't have to stay all the way up here. You don't have to decide every night if you should stay in another day. Just get out when you make some money, and then you come right back here again and you set up again. You're still at the relatively low part here. You don't know that yet, but you could get back in here right this day. After it closed, then it closed back above, right? Closed below the 5-day. We got out before that, and then you could get right back in and right here and so forth and trade it up. So that's essentially how technical analysis works. When you're doing professional analysis of anything, you can't be subjective. I mean, that's the first rule of technical analysis. There is no subjectivity to technical analysis. And I'm discussing this now from a scientific perspective on anything, medicine, anything you're looking at, you have to be objective. So the beautiful thing about the discussion we're having here is you can ignore everything you read about technical analysis with the exceptions of those things you can backtest. And if you can't backtest it, just ignore it. Not that it doesn't give you some kind of benefit in the markets, but how much benefit do you need if you're making money with a simple moving average crossover system that gives you exact entry prices? I don't know. If you want to be a student to the market, there's nothing the matter with studying all those subjective methods. There's nothing the matter with it all, and I've studied a lot of them. But at the end of the day, if you want to be a trader, either a recreational or an amateur or a professional trader, you need to be able to backtest your systems so that your stomach can take what you're doing. so that you have a statistical basis with which to trade, so that you can, if you want to raise money, no investor is going to say, hey, how do you feel about this? How do you feel about that? They may ask you that, but they're not going to give you money to manage for them based on that. You need to be able to back test the system and convince somebody that, hey, I'm raising money based on this system, and this is what we're going to do. And then they either will go with you or not. But you need to understand statistically how your system's going to perform. That's why, again, I say this is for entertainment purposes only. You should back test all of this with an Excel or some other type of spreadsheet. You can get all of the data you need to get to backtest for free online. I don't want to say the names of the places here in this video because I'm not really sure if that's the appropriate thing to do, but you've heard of all the major sources. If you go to major websites, check for historical data free. Just Google historical data free. Start with daily data. Make sure it's clean data. Use the major instruments and just backtest. I used about 8 years of daily data, and I backtest daily systems on about 8 years of data. If you go 10 or 20 years, the market changes not how it trades, but the volatility is different. So you need about 8 years of daily data to test daily systems. Once you become proficient at building daily systems, then you can test hourly systems and minute systems. I've found testing other time periods besides those three to not be as helpful. 1 minute, hourly, daily. Now, can you build 5-minute systems? Can you build 4-hour systems? Can you build weekly systems? Yes, I've tested all of those. But there's a big difference between testing something and being able to trade it. Being able to have the stomach to stick with something. And that comes from your personal makeup and also the amount of money you have under management. If you don't have much money yourself that you're trading, I would just, as for entertainment purposes only, go with a 1-minute system. You can manage your risk, really tight. You may lose a ton of money, but you may lose a ton of money on everything. So it's, to me, the shorter your time frame, the less risk you have. Not always true. I saw the S&P 500 drop the other day almost 200 points. That's a tremendous amount of money to lose in less than a minute. So you have to be careful with everything that you're doing. All this is for entertainment purposes only. You've got to be responsible for your own behavior. But keep in mind, testing 1 minute, 1 hour, and daily data sets, which you can get for free on the internet, is a really good way to backtest and see for yourself that this simple moving average crossover system with exact entry prices, see if it works for you. Maybe it doesn't work for you, but my backtests look great. Again, the 1 minute is more difficult because if you stretch 1 minute, a day of 1 minute data to another day of 1 minute data, you have a huge lull at night. And so you want to be careful when you're testing 1 minute data through the night. It's not that bad if you test hourly data on a currency and it trades through the night. Some of these doesn't matter because they don't trade through the night, but a lot of things trade 24 hours a day or near that, especially the currencies. And so you have to be aware that you have to manipulate some of this data in a way that's not going to falsify your results. That's why I like daily data. You don't have to hassle with that in the beginning. So I recommend if you're going to backtest in the beginning, start with daily data and backtest about 8 years, which is about 250 bars a year, roughly. So about 2,000 days, trading days of data. And you skip all the weekends. It'll just come to you with all the weekends skipped out of it. So that's what I recommend. I also recommend when you're testing data, you stay away from the open. Use the high, the low, and maybe the close. It depends on your system. You can use a close on this type of system, but the opens are notoriously not accurate, in my opinion, for backtesting. But certainly the high and the low and the close are numbers that you should be able to use and come up with some reliable data. Again, I want to make sure I'm clear. Just because it works in the past doesn't mean it's going to work in the future, but it's a great way to test for yourself how a proposed trading system is going to perform going in the future. You can, and it may not work that way, but it gives you an idea of what it might do. Keep in mind, you can only do that with an objective system. And that's why all of the other technical analysis systems that are not objective, I don't spend any time on anymore. If it's not an objective back-testable system for trading analysis, or for technical analysis, I'm not interested in it. I have no interest in it at all. And again, if you're a student, there's nothing the matter with studying everything and growing as a person. But I'm past that point. So that's my basic rundown for you for technical analysis. You'll find that if you just start using visually the 5, the 20, and the 200-day moving average on stocks, you will be amazed at how your understanding of what price action is like will increase. But when you actually build a spreadsheet and do it for yourself, that's when you're just going to be blown away, because it is very difficult to do what I do on a computer, to try to do it. As you can see, I've been showing you how these things work. Very difficult to show it. If I showed you a computer program that I've built, I don't want to give all this stuff away, it's all proprietary, but when you do it by computer and you actually data mine these markets, it's amazing what you discover using these simple things. I'm not trying to tell you to go off on a tangent. Just model a simple moving average crossover system and use the previous day's close as your entry for the current day, and use a 5 and a 20 day. That's a ton of information I just gave you there. Use 2,000 days to back test. Build a simple little algorithm for yourself. It's very easy to do on an Excel spreadsheet, and see for yourself exactly how it works. And I think you'll be shocked at how incredibly useful technical analysis is, and how simple technical analysis is when you take the subjectivity out of it. Now, let's move on to the second section that I discussed with you. I told you I'd show you another way of doing this. These tables I'm going to show you are RBAM Research's algorithmically generated entry prices. Now, this particular section here doesn't have a trend following component. So these basically have fixed holding periods, and holding periods, you'll discover, are necessary to choose when you're building trading systems. So for technical analysis, to determine if a system back tests appropriately, you have to choose how many days you're going to hold the position. And so we have 1, 5, and 20-day holding periods here. We cover 190 stocks. It's out by 7 a.m. Monday through Friday. You can see these are out for tomorrow, the 26th, which is Monday. I'm doing this video on Sunday. So you have these 3 buys, 1, 5, and 20. So basically, enter Monday, close out just before close on Tuesday at a loss. Enter Monday, close out 5 trading days later, just before close at a loss. And the same thing for the 20-day. Now, what about if you make money? If you make money, you take it as soon as you make money. If you make a profit in the 1-day column, you take it. If you make a profit in the 5-day column, you take it. Now, again, just like the previous moving averages we used, when you get out is, that's a much more delicate situation that's beyond the scope of this video. Getting out is, you can turn that into a mechanical exercise too, as we've looked at up here previously. We said you get out when your 5-day crosses below the 20, and you can set it up that way, but you leave a ton of money on the table when you do that. So these have defined holding periods: 1 trading day, 5 trading days, 20 trading days, and you get out at a loss if you haven't taken your profit sooner. So that's the way this system's built. We cover 190 stocks, and you see here for tomorrow, NIO has a specific entry price, $17.14. The 20-day hold, $17.54. We know what the statistical probabilities are of these prices producing a profit over time. So is it going to do that in the future? We have no idea. But we think that it helps us and assists us in making trading decisions. Again, for entertainment purposes only, you've got to do your own work. You can see we have Tesla here. We have Macy's is showing 0. What that means is our algorithms is saying tomorrow's not a good day to buy Macy's, in our opinion, for entertainment purposes only. Now, this is an algorithmic system with no trend. Let me show you one that does have a trend. This algorithmic system here, if I can find it, is a system that we've developed. It's not on our website. We use this just to show YouTubers as a bonus. But this is a 30-day hold system that does use moving averages, and it's more sophisticated than a moving average system I showed you earlier, but it does use moving averages. And you can see it's going to give you a buy, flat, or short signal. And these come out internally in our company every morning before 7 a.m., but we don't publish this particular table. And they're 30-day holds. So basically, if you got in, took a position, let's say today, you would close it out, worst case, 30 trading days, or take your profits sooner if you got them. So this system is, we've done exactly what I was telling you or mentioning to you or suggesting to you that you do. We've taken moving averages and we've built a moving average crossover system. Again, it's more sophisticated than the one I showed you, but we built the one I showed you as well, and it works excellent when we back test it. But let's take a look at this. Again, entertainment purposes only, you have to do it yourself. But this shows you that the SP 500, we use the E-mini futures as a proxy for the SP 500. You can see for tomorrow, the 26th, it's showing short at 37.83. So that means if the market trades through 37.83, this indicates it might be a good idea to go short if your own analysis says that it is a good idea. Same thing for Apple. Tesla's a buy. Ford's shorts. All these are shorts through here except for Tesla. You can see again, it gives you a defined holding period, exact entry price, tells you what to do. Short or buy or stay flat. Some days these will come up and say flat. So that's how you basically use technical analysis. You come up with a system, a simple system that gives you a signal, buy, flat, short, and an exact entry price. And at some point, to backtest, you're going to have to choose a holding period, which is, again, beyond the scope of this. But you can just, when you go to build your own, if you do, and I recommend you do, just choose whatever you want. A 5-day, 10-day, 20-day, 6-month. It does make a difference. In general, when you're building trading systems for technical analysis, the longer you're willing to hold the instrument, the more money you're going to make, and the higher the win percentage is going to be. That's in general, and that's also for very experienced system builders. But I think even if you got started and you follow what I've given you here today, you'll find that the longer you're willing to hold the trade, for example, if you go up here and you take a 1-day trade, the win percentage on a 1-day trade is going to be less than it would be on a 5-day and less than on a 20-day. The profit's going to be higher on a 5-day than it would be on a 1-day, and higher on a 20 than it would be a 5 or a 1-day. Again, all hypothetical. There's no guarantees for the future. It's all for entertainment purposes only. Past performance is not indicative of future performance. But in general, that's what we find in our back testing. Does it mean anything for the future? I have no idea. You have to do it yourself and trade at your own risk. But that's what we find, and I think you'll probably find the same thing, at least from a hypothetical perspective, if you build your own simple trading systems. Again, I want to emphasize, when I say building technical analysis trading systems, I'm talking about this. I'm not talking about sitting down on a couch and trying to figure out what I'm talking about. I'm talking about build yourself a simple 5- and 20-day crossover system and use the closing price as your entry price for the next day. Just do that. That'll change the way you look at these markets. It'll change the way you look at technical analysis, and hopefully it will focus you in on the most important thing, which is how to trade objectively, as opposed to trying to spend hours and even years learning techniques that are subjective and can't be backtested. So you can get all of our information absolutely free, no cost. And by the way, we don't have it all on here, but I'll show you. We cover 190 stocks. We cover the major forex pairs. We cover BTC for crypto and the most liquid futures contracts. Everything but the stocks are longs and shorts. The stocks, as I showed you, are longs only. That little buy, flat, and short box I showed you is not publicly available. But we put them all out Monday through Friday by 7 a.m. at rbamresearch.com. They're absolutely free. Don't cost a dime. No credit card required. Follow the link in the description below. I would sign up for those and just come by and take a look at them, and then maybe it'll inspire you to build your own simple moving average system for technical analysis. If you do that, it'll probably change your trading life for the better. It'll help you make very quick decisions without studying for hours, and that way you can cover a lot of different instruments. As you'll notice, we put out 190 plus stocks every morning before 7 a.m. and it's fairly straightforward for us to do it because it's all coming out of the computer. If you like this video, please click the like button. If you like our series of videos, please subscribe. We'd love to have you as a subscriber. If you have comments on this video, we'd love to hear them. Please keep them positive. This is a tremendous amount of work doing technical analysis and the decades worth of analysis. We could be completely wrong, but at least we think we're trying to be helpful. So leave us a positive comment, please, if you can. And keep in mind that everything you've seen or heard on here is for entertainment purposes only. You can't use any of our information, any of our analysis, any of our quote advice. We don't give advice, but you can't use any of it other than for entertainment purposes only. You have to do your own analysis, build your own trading systems, come up with your own decisions, and you definitely trade at your own risk. You've been listening to rbamresearch.com, and please tune in for our other videos. We put up quite a few videos. We're approaching 300 videos up now on YouTube. Thank you for listening, and please leave us a comment if you have any questions.